Good morning. First, the last assignment on the balance sheet of the question, there is called a bounce payable. And if you read additional information, they're mentioned about note, but there is no note. So there's only one debt. So just change that bounce to note. So that will be, some of you already finished, they just figure out there's only one debt. So kind of the two are the same, but in case you are wondering. Okay, so that's about that. So today we will finish that additional example. And I do have a few things to say about chapter 23, because there are some additional you need to see the camera. So I think this is the one we did the last time, and I realized anyways, I saved it in a different place. It turned out it was not available to you, but that's okay. That's just have a quick review of that. So so we look at all the assets, right? And so the working capital assets are pretty straightforward. There is a fair value through net income investment. And we said for statement of cash flow purpose, that's treated exactly same as inventory. You buy the cash paid to purchase it is a cash operating outflow. Cash received from selling it would be operating inflow because the nature of this investment. Now, keep in mind, there will be both unrealized gain or loss or realized gain or loss. So unrealized gain or loss is not cash gain or loss. So when we do the cash flow statement, we need to adjust that. Realized gain or loss are also non-cash measures because the cash associated with the selling it would be the cash receipt, right? So we need to replace realized gain or losses with the cash received to sell it. So that's about that. And there's quite a bit of a few things happened in land, building, and equipment, but none of that is new. Like cash paid to purchase it is financing, investing outflow. Cash received is investing inflow. But in between, we need to remove the gain and losses from the operating part, and because the cash flows are investing cash flows, right? And when the asset changes, especially partially depreciated assets, when they're sold, they also affect accumulated depreciation, right? So the change in accumulated depreciation is part depreciation expense, which need to be adjusted, and the other part would be the removal of the cumulative depreciation of the assets sold. One last thing about this part is non-cash financing investing activities. They should not be in the statement of cash flow proper. Instead, they should be disclosed in a note. So that's sum up what we did a lot of, sometimes a T account would be helpful. If you look at the solutions, instead of a T account, but they do have these like a small table to analyze how some of the account changes. We did a couple here. We did the investment account, and I think we didn't do it, but we could have done for the PPEs, right? Okay, so that's about that. So let's move on to the liability side. So first one we have here is accounts payable. So that's operating. Yes, that's the difference between inventory purchased and the cash paid to purchase them, right? If you paid more than you purchased, your accounts payable goes down. Otherwise, your accounts payable goes up. Here we have an income tax payable. Wait a second. Yeah, okay. Because we have that in the homework, I think. So I'm just make sure I'm not talking about a homework question. I don't think it is, just happen to be here. So income tax payable is the difference between tax expense and the tax paid. So tax expense is subtracted from net income, but we need to adjust change in tax payable to determine CFO. So this will be exactly the same as, say, wages expense, right? Utility expense. It will be exactly the same. It's operating expense. So the cash paid for taxes is operating cash flow. Okay, so this again is operating. Okay, so here the income tax payable reduced by 9,000 means tax paid is $9,000 more than tax expense in the income statement. Make sense? Yes. Okay. And accrued liability, salaries and wages, so that's operating, right? That's, yeah. And then we have a dividend payable. We did not see this before either. So what is the cash flow implication of this one? So dividends is not an expense. It's not in the income statement, right? But the dividends explain part of the change in retained earnings, right? So however, dividend declared and the dividends paid may not be the same. That's hence the dividends payable. There's a, if you recall, there is a leg, there's a declaration date, there's a date, date of the record. What is that? Thunder. And then there is a date of payment. So there's like about a month in between, right? A few weeks. And so this one means whatever the dividend declared, they paid $30,000 more dividends. There was dividend payable 50,000 at the beginning of the year. That's only 20,000. So this one, is it operating or it's investing, or should it be financing? This is related to financing, right? It's the difference between dividends declared and paid, right? Dividend declared would be part of the change of retained earnings, but dividend paid is cash, financing cash outflow. And then we have long-term notes payable. What did we have any other information of long-term notes payable? No, I don't think there is any other additional information. Any of that is related to the note. Yeah, no. So therefore, this will be all financing. Further, not only all financing, this will be all repayment because the balance decreased, right? All repayment. Well, when there's no information, we have to assume the most straightforward situation. And the last one is, the second last one is common shares that increased 100 96,000. I think there is something about here. Yes, there are at least 2 transactions here because the additional information item 1 said that during the year, Como obtained land with a fair value of $100 in exchange of its common shares. I don't know why that one is here. Common shares. Yeah, it's here. It's in the Word version of this question, everything is shown, but when I converted it to Excel, like it's a little bit of problem here, right? So there's 196,000 increase. So that means in addition to the 100,000 shares issued in exchange for land, there are additional shares issued for cash. That's what we have to do. So this is also financing. And there are 2 parts of that. 100,000 issued for land. So this is a non-cash transaction, okay? And there will be additional 96,000 worth of shares issued for cash. If it's not, we would have been told, right? So that. Okay. And this part, net income, right? So operating part would include net income of, what's the net income? We at 208,000. Okay. However, there is a increase only 144,000. So that implies, which do the difference, 208 divided by 144,000, that's 64. So that means 64,000 dividends declared. How much was paid? We paid more, right? 64,000 dividends declared. No information, we have to assume it's cash dividend, but there is a change in dividends payable, a decrease in payable of 30,000. So that means the total cash dividend paid is 94,000, right? Like a, yes, yeah. Okay, so with that, yes, so we analyze all that, and these, as I said, it's like it's even before the step 1 of the 4-step process, right? So I have step 1, 2, 3, 0 here set up. I didn't do anything yet, except I did a part 1, which is, you know, we know there is a net decrease in cash of 74,000. That's where we need to end, right? Other than that, so that's our step 1. Step 1 is net increase in cash of 74,000. That's what happened during the year. And step 2 is just list all these things from income statement here. So that's what I have. And step 3 is now we're going to find out all the cash, right? And for the operating activity section, we adjust these accrue measures to get the cash measure. So I have like a formula in here. So that's why these numbers are exactly the same, but when I put the numbers in there, it will be different. And then the also operating and the financing. I already, let's put it this one. We just said dividend paid is how much? We just said 94. So we'll put it here because we already did that. And we also just look at the long-term note is, I think, let's go back to see. So long-term debt repayment 46. Yes? Yeah, 46. So let's just put that O in there. 46. Oh, that's a payment. Yes. I think there is one more thing, if I remember correctly. We just finished that section. That is the common for cash, right?
Yeah.
Exactly. So we might as well put it in here. Because we just did it 96,000. Yeah. Okay, so we did that part. Okay, so let's go back to these parts. First of all, from sales revenue, the counterpart is cash collected from customers, and the difference between these two is change in accounts receivable. So if we go back to see how the accounts receivable change, accounts receivable increased, so that the 77,000 should be not added, exactly, subtracted. And so 922 is cash collected from customers, right? So the next one is investment income. So like I had several columns here, so I'm just going to put in the numbers. Instead, no place to explain, you just make reference to that. So that increase in 90,000, I think there's an unrealized gain and there's realized gain. There's no purchase, there is some sales. There's some sales, there's unrealized gain, there's a realized gain, and there's a cash. So there's 4 things, right? So we kind of, let's go back to see what we analyzed here. Unrealized gain is 64,000. We have 44,000 worth of investment sold for 72,000, so there's a gain of 28,000. Okay, so first of all, we should subtract the unrealized gain, shall we? Yeah, unrealized gain is 62,000, so that should be, that's no cash goes with it, right? So that's why we subtracted. That's not cash gain, it's included in investment income. So that's why we subtracted. And also, there's a realized gain of 28. That's not the cash of the transaction. The cash of the transaction is that proceeds of 72. So we do not want the gain part. Instead, we want the 72,000. That's the cash. Does it make sense? So the investment income of 90,000, that's the realized and unrealized gain, but that's not the cash. The cash is what you get when you sell it. So we made all the adjustment. Okay, now I don't have room to put all the explanation there, but all the explanation is in the previous spreadsheet, right? So wait, any questions? Make sense? Okay, so the next one is cost of goods sold. The cost of goods sold and the cash paid may be different. The difference will be in 2 accounts. Inventory, if that changed, and the accounts payable, right? So let's go back to see the inventory increased. So that should be subtracted, and the accounts payable also increased, and that should be subtracted.
Yes.
Accounts payable increase, that should be subtracted or added? Added, right? So one is subtracted, one is added. So let's go. we need to subtract this is the inventory increase, and we need to add this is accounts payable increase. Again, I apologize, I'm condensed this here, but if you look at this number, you wonder, you just go back to the previous pages. And operating expense, I think the operating expense here, we have several things like supplies expense will be an operating expense, right? So supplies inventory is related to that, and accrued liability related to like salary, wages will be an operating expense. I do not see anything other than that. Is it actually, let's see, what I think our salary expense were actually separated from that. Anything else? Oh, prepaid insurance. That's also that. So I have, yes. We should have removed those two. One is decrease in supplies, that's a 4,000. Decrease in asset is added, so that's supplies. And then we had a prepaid expense decreased, so decrease of that is added, that's prepaid expense. So that adjusts the operating expense, except one more thing, that's the depreciation. I think somewhere in the question it said the depreciation expense are included. Depreciation expenses are included in the operating expense, and we already analyzed our accounts, so we determined that the depreciation expense for equipment is 62,000, and the depreciation for building is 40,000. Those are non-cash expense we should add it, right? So we should add a 40,000, that's depreciation on the building, and 62,000, that's a depreciation on the equipment. So that's all the adjustment. Wages and the salaries, it's separated. Sometimes it's part of the operating expense, but you know, companies are like individuals, like within the boundary of what must do, they have personalities, they do things different, right? So we just need to read them carefully and you know, don't make assumptions. So here, salaries, wages payable, I think it increased salaries, increased 16,000. Yeah, so that should be added. Yes, 16,000. Okay, and interest. Interest expense is 95,000. I do not think we have interest payable. So that means that's the amount paid. Okay, so we don't need to make adjustment. So that's fine, no adjustment. And the gain or sales of land, that has to be removed, right? Because the cash is financing cash flow. Loss on the equipment, that should be removed. Because that's, I don't think we need to add. That's also financing, investing cash flow. Income tax expense, I think there is change in income tax payable. Income tax payable is decreased by 26,000. So in addition to that, we must pay another $9,000 here. So I I think that's all. So this amount is, this is the accrued total, that's net income, and this is the cash total, that's the cash from operating activities. And we already finished the financing section, so let's look at the investing section. Because of what the non-current assets, right? That's where we look at. Land, we already said that there's a 100,000 worth of purchase. And as a result of that, the land should increase by 100,000, but it's only 40,000. So we figured that land worth has a carrying amount of 60,000 must be sold. And but on the income statement, there's a gain. So let's say the proceeds of selling land is 73, right? Because there's a gain. So that's the proceeds from selling land. There's another $100,000 of land purchased by issuing shares, but that no cash, so we don't include it here. Building sold. Sorry, that's it. Building sold. Let's look at that. $130,000 paid for additional buildings, so that's cash outflow. Wait a second. Building purchased, yes. I said the building sold, but nothing was sold here. Okay. And we have both sales and the purchase of equipment, and we need to use a gross method. We cannot net it, so I have to list the cash flow for cash. Yes, the building sold has a loss of 10,000, has a cost of 46,000, and I think in the additional questions tell us they have a carrying amount of 14,000. So we concluded that the proceeds from sales is 3,000. That we did those analysis last time. And then last one, we also figured out 38,000 paid for new equipment. So that's 38,000. Okay. So now I think we put everything in, and yes, I already had the functions inserted. So it was just a calculator for me already. So that's what we want. That's what we want, right? So that's exactly what we got. That's the change in cash. It's an increase of 74,000. So step 4 is just to organize this information into proper format. If we report a statement of cash flow in the indirect format, we'll start with this number and we'll factor in all these adjustments properly presented. And don't forget the additional disclosure information, non-cash financing, investing transactions. Don't forget interest paid and the tax paid should be disclosed. If we use the direct method, then operating cash will be taken from this column. And in this case, interest paid and the tax paid are already part of this operating cash flow section, so we don't need the additional disclosure anymore, but we still need the non-cash financing investing transactions. Okay. So I did that. So would it be okay? Well, I would just show it to you instead of have to type the whole thing. Okay. Yeah. So I did that. I actually, where is it? Okay. I think it's in my download. Yeah, here. Okay. Yeah, so this is the indirect method. I started with net income and then made all those adjustments, as I said, but I could have, I think I could have organized it in sections. Like usually they fall into three categories: non-cash expense, like depreciations, and the second part will be gain and losses from non-operating transactions, and then third part will be changing in working capital. Don't have to be in that order either, but if you want to be nice, make it organized, you can do that. Didn't here, but anyways, I get the job done. So, not the best, not the perfect, but it's correct. Okay, so that's just the net income with all our adjustments. We got to operate, and this is our investing cash flow, and this is a financing cash flow. Don't forget to tie it to the cash on the balance sheet, right? It's not complete unless you have that. And then the additional disclosure information. That's non-cash financing, investing activities, and interest and tax paid. But if you use the direct method, I just take the last column of the operating part of the worksheet, and the interest paid and tax paid are right here. So you don't need to make additional disclosure, but you still need to disclose the non-cash financing and investing activities. And the last but not the least, just when we talk about direct versus indirect method, we're only talking about the operating cash flow section. There is no different format for financing and investing part, so I didn't repeat it here. So the last question is about let me see, I think it's the interest expense. Did I share this? I don't think I shared that with the class. Okay, sorry. Here's the financial statements. Maybe I'll make it a little bit smaller so that you can all fit in a one page. Yeah, okay. It doesn't change. Okay. Yes, I fit it all in one page. So this is the indirect method for operating cash flow. Start with the net income. And these are all the adjustments. Every single one of them is in the worksheet. And then that's operating cash flow, where investing and the financing cash flow, regardless which method you use, it's the same, tied to the cash balance on the balance sheets. So that's the requirement number one. Don't forget the disclosure here, non-cash transactions, interest and tax paid. Now, if we use the direct method, the operating part will be different, okay? But also interest paid and tax paid will be there. So the disclosure information is just the non-cash transactions. And the last one is that I think the question is, about the treatment of, is about the treatment of the interest, I think. Yeah, what's the last question? Yeah, last question is in the question part. Anybody has the question I posted there online that's there? I think it's just, do you have choice? What's the interest payment treatment? And if first you have choice to be operating or financing. under ASPE, always operating. That's pretty much the answer. Okay. All right. Any questions about the statement of cash flow? Okay. Okay. So actually, let's see. I have some. No one has a question online as well. Okay. Do you guys all have your? Can you guys all access the Brightspace? We don't have anything. No.
Brightspace.
Yeah.
You can just look through your phone.
Yeah, get your phone, and because I have some questions that I'm not going to show it here, so we do like a like a sort of like what we did before, the clicker sort of exercise. So let's do that, and I'm going to turn it off here. I'm going to turn it off here, so you guys would see the same thing as people online sees. So, okay, so I have some, yeah, nice, that's that. So I have some, okay, let's start with the sum of the statement of cash flow questions, okay. Yeah, okay, so this is the first one.
Professor, which cash flow question is it?
Hmm?
Which cash flow question is it? Oh, it's not for us?
You cannot see it?
No. Oh, Zoom. Okay. I was a little bit confused. Okay.
Okay. So the people online have no problem. Are we all in here?
I should download Zoom on my phone.
Oh, you don't have it?
No, I don't Zoom on my phone.
Oh, you can just look at, because this is not a quiz or anything. You can just share with them, just so you can see what it is. If you don't mind. Do you mind? Do you mind? Yeah. Yeah, so you can just see it. Yeah. Okay, so this is the first question. The question is, the direct format of statement of cash flow is more often reported because cash income is very important. And is this statement true or false? So, okay, so now here's the result. 70% of us it's false and 30% is true. Anyone wants to elaborate? Like anyone says false wants to elaborate on that? Indirect is more used, correct. So the statement is false. Yeah, statement is false. Most company use the indirect method. There are pros and cons for both, right? There are pros and cons for both, but most company use the indirect method. Okay, so that's question. Let's check the other one. Here. Read it carefully. Read it carefully. Read it carefully. Okay, so, and I think you guys are ignoring my suggestions. Okay, because I heard someone was saying it's investing. That's true, but this statement, if you read it carefully, is false because it says gains should be added to, loss should be subtracted from. But it's the opposite, right? The gain is already added in net income, so we should subtract the gain, add the loss. Yes? Yes? Or you guys didn't agree with the answer?
So the answer here is true or is it false?
False.
False.
The statement is false. Why? Because the gain should be subtracted. The loss should be added. That's how you remove them. That's why I said careful. Read it carefully. Okay. Questions? Okay. All right. Let's see. Okay. Let me see. Oh, okay. The reason I wanted to, I turn it off because I can see the answers. So otherwise, the herd effect would be like if somebody sending an answer, you would just go along with that without thinking, right? Okay. Okay. So that 1, 2, 3. I wanted. This is pretty much the same we just did, right? So pay attention, people. This is just what we just did. When the dividends payable decreased means you paid more than the declaration, right? So the statement is correct. Statement is correct. Okay. Statement is correct. Here. A count to 5. 1, 2, 3, 4, 5. That statement is false because this statement is very ambiguous because if the statement is that interest paid is always operating cash outflow under ASPE, that's correct, right? But I didn't say which one, so then it's not true. Okay. Last one. Cash flow. I'll count to 5. 1, 2, 3, 4, 5. Oh, was we end up with a tie. Okay, so this is actually part of the homework question. Okay, so I tell you it's a false. It's not true. It's too good to be true, and it's not true. You know, nobody would have cash flow problem if you can just increase depreciation and you will have more cash, right? That's not true. But in the assignment, you need to explain why. Okay, so that's it about the statement of cash flow. Now so chapter 23 is that there are some other disclosure measurement issues that outside, you know, the what we did, like the items in the financial statement per se, right? So, you know, some of them we already know, some of them are a revisit, some of them maybe we just sort of know. So let's have a few look. And I will start that with by just asking questions. As I said, these are not topics like a derivative. Before we talk about the derivative, if you never studied derivative accounting, you wouldn't know, right? But this, I think lots of these you already know. So I would just bring it up by looking at these. I didn't say that was the last one, yeah, but it was the last one I've seen my cash flow. Sorry about that. Okay, then you count 5. 1, 2, 3, 4, 5. Okay, so okay, so 96% of us says it's true, and it is true. There is a principle associated with this. Do we remember what that is? Full disclosure. Full disclosure, right? So that kind of basically company is responsible to inform the users of anything, not just the providing financial statements. That's why there's MD&A. That's why companies sometimes would hold conference calls if there's anything important and things like that. Right, so that's that. Auditors, well, the formal financial statement should be filed for sure, but you know, not every thing that if it's not covered in the GAAP, you don't have to say. So it's a principle-based approach that honors on the management, on the firm to inform public, right? So that's that. Okay, so full disclosure. Okay, I'll count to 5. 1, 2, 3, 4, 5. Business diversification tends to make financial statements easier to interpret. 78% of us says it's false, and it is false. Okay, so this is actually a pretty prevalent problem because most public companies now we see they have consolidated financial statements, and that means the companies have subsidiaries, have international subsidiaries sometimes. So like it's not just the financial statement of one company, it's a bunch of them. And sometimes they are in very different businesses. Like you have like lots of companies have finance service part. And the financial statement of different companies may have different characteristics. And when some of you may have taken the statement analysis course, the first thing they will tell you, you should read financial statement in the context of your understanding of business strategy, the industrial characteristics, and even the the country's political economic situations, right? So for instance, some businesses are very capital intensive, and you would see that asset turnover ratio will be very low, like a power company, but other companies will be a lot less in capital intensive, like a retail, and their turnover ratio will be very high. When you combine these two companies together, that ratio is hard to make sense of that, right? So what do we do about it? There is actually an effort to help with this confusion that's called the segmented reporting, right? So if you look at the financial statement, actually companies are required to provide financial information for their main, they call it the operating segments. If an operating segment is significant enough, they would qualify as a reportable segment. And like revenue, expense, assets, liabilities of that segment should be disclosed as a segmented reporting, just for that reasons, because different segments may grow at a different rate, may have different characteristics. So by desegregation, you can understand overall financial performance better. So that's another thing. Okay, so actually, I think just that was the second sentence is not a full sentence. Ignore it. I think it was I didn't delete the complete as a carryover from the previous question. Okay, just first sentence, just one sentence. Okay, count to 5. 1, 2, 3, 4, 5. Okay, so the financial statements of a particular fiscal year should not include anything that takes place after the fiscal year ends, I think, or ends or ended. 61% of us this is true, 39% of us is false. That tells you the democracy doesn't always work. A correct answer is actually false. Okay. So it is true generally statement of financial position date is a cutoff date with the transaction. We make adjustment on that date, right? However, usually it takes time between the fiscal period and the financial statements are complete, right? So sometimes if things happened during that period that affect you, like, like we have lots of assumptions, interpretations used to prepare financial statements. But if based on your best knowledge, best estimates, you would report a story one way, but because the uncertainty, after a little time, you know better. So for instance, if you're in a lawsuit, right, you're being sued, and at the time you have to estimate the likelihood that you will lose the case, and in case you lose the case, how much you will have to pay, right? And recognize as contingent liability. Now, at the end of the fiscal year, the case is still pending, and you think either you pay certain amount, but then before the financial statement is complete, the case is settled. You end up having to pay a lot more, let's say, a whole lot more than you anticipated, right? So in that case, make this known would make your financial statement misleading. You have far higher profit, not reflecting the actual loss, right? So what do we do about it? Well, both IFRS and ASPE have guidance on that. That things happened after statement of financial position date, before the statements are completed. It's called a subsequent event. Okay, some subsequent event, like the example I give you, is about the information about the condition that's already existed. And if that's the case, you should use this information, because what happened there affects your estimate at end of the statement of financial position date. So you actually can use that information to make adjustments. Some subsequent event, it's entirely new event. Has, like, say, after fiscal year and there's a flood, and that's important. One of our plant is submerged, so production has to be stopped. That's significant, but that should be reported properly in the next, because that's really what happened in the next year. So that should be properly reported in next year's financial state. But that is significant. That would affect people's assessment of the company. So for that kind of a subsequent event, there's no justification to put it in the financial statement of the year that's already over, but you should disclose that. Okay, so subsequent event affect condition that's already existed before the fiscal year end should be incorporated. Adjustments may be made, but it's for the events that's related to the conditions that did not exist. You just, at most, you need to disclose it. You don't need to actually make adjustment. So that would kind of help circumvent or mitigate the situation that financial statement will not be up to date, would be misleading. Okay, so that's another issue that's discussed in that part in chapter 23. count 5. 1, 2, 3, 4, 5. Okay, both annual financial statements and quarterly financial statements of a public entity are audited, and 68% says true, wrong. 32% says false, correct. Okay, so this is related to interim reporting. Okay, I could not think of a question, come up with a question, so I have to make it a question. This is not about auditing. This, you know, one of the characteristics to make a accounting information useful is timeliness, right? Timely, like, you know, like if too late is not going to help, right? So between annual reporting, that's a 365 days, a lot of things could happen, right? So that there's always argument that's like, you know, you need to provide information. So that's what interim reporting is about. Interim reporting is not required, like a GAAP, neither GAAP nor SB require you to provide interim reporting. That's like the Stock Exchange Commission requires interim reporting, right? So that's, they said if you're listed in stock exchange, you need to file these things. But SB and IFRS, I don't think SB have anything. IFRS have some guidance. IFRS have some guidance about how interim reporting should be reported. That's not there. In fact, that North America have different interim reporting requirements for public companies from European countries. European Union countries, they do not have a quarterly reporting. They have semi-annual reporting. They have every 6 months, whereas North America, like public company, are required to file quarterly report. So a couple of issues. One is there is a concern, like I think towards the end of Trump's presidency, he kind of like, he usually started to just blast on an issue like, you guys are idiot, you did not do anything right, this is the right way to do it. So he mentioned about this, and sometimes he had some points, but it's far from he is the only one genius to know about it. So there is ongoing debate because yes, quarterly reporting provide more timely information. That's definitely the advantage. The disadvantage is that if you focus too much on quarterly results, you may kind of fixate on short-term performance, and that in the long run may not be a good thing, right? If it may prevent management in making decisions that does not show results quickly, you know, and it will be penalized for not so good short-term outcome. So that's a concern. But there's lots of reporting issues because, you know, like for instance, tax, depreciation, there are lots of numbers you will have to allocate to quarterly or semi-annually. And so auditors are not, companies are not required to have their interim reports audited, and the auditors are reluctant to do that just because there's way more estimates involved in quarterly reporting than annual reporting. Sometimes they may, you guys have a auditing course already, so you should know. Sometimes the company may have their interim reports reviewed. Like if you go to the bank, you want the loan, like the bank may want some more updated information rather than like a 10-month ago annual report, right? And then they may want some assurance if it is not audited, maybe have somebody review it. And that's a less rigorous review, like a less rigorous audit. So sometimes you'll see that, but usually it's not audited. But the key thing is the interim report, why we have them, what are the pros and the cons, and what are the issues in terms of measurement and the disclosure. Okay, so these are the things chapter 13 talk about. I think they're relevant, and I think they're, oh, I did not share the results yet. I did share. Okay, one last question. Okay, I'll count to 5. 1, 2, 3, 4, 5. Okay, I share the results. Okay, intentional distortions of financial statements are considered a non-compliance, but unintentional mistakes are not. 43 of us is true, 57 is false. That statement is false. Both intentional distortions and unintentional mistakes are compliance, non-compliance. Auditors' responsibility is try to identify both, like identify all the non-compliance. I don't think you can hold them legally responsible to say, well, there's a fraud, you audited, because there are sometimes company intentionally can deceive the public, that's criminal. But auditors will do their best to try to identify all these non-compliance, intentional and non-intentional, to improve the credibility of the financial statements. But if somebody's hell-bent to lie, it's very, we're all human. There's only so much you can do, right? However, this is if you read auditor statements, that they do not guarantee that's fraud-free or anything like that. It's just impossible. But sometimes shareholders take the auditors to court, and then you will be like, the judges may not be accountants. So there have been cases that the auditors are found responsible for the fraud committed by the company. And it's hard to say if auditors are on the in or not, because it's like some auditors have done that, like Arthur Andersen, right? They actually kind of part of the partner in crime with Enron, right? But lots of times, auditors did their best, but they could not uncover every misstatement, every fraud, so anyways, but when they audit, they should uncover, identify all of that. All of that will compromise the transparency, compromise the quality of financial reporting. So these are the issues in in chapter 23, and it's kind of a long chapter. Each of these issues can be expanded, but I did summarize the highlights of some of the issues in the PowerPoint, and I posted. So this was not, maybe I will throw in like some simple questions, just the basic. So just to make sure we are aware of some of the basic issues, like a question like we did here. Okay, so it's not going to be a big part. I would say the all the final exams, this will be no more than 5%. But at least, review this and go over the PowerPoint, just the highlights. So that's all for today. And assignment is due tomorrow. And then we will meet again on Tuesday to talk about the final exam. Okay? Have a good weekend.